This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Welcome to The Commercial Investing Show, where we analyze, explain, and exploit the opportunities presented in today's commercial property marketplace. If you're interested in apartments, mobile home parks, self-storage facilities, and other income property, you've come to the right place. We'll explore what's hot and what's not in markets nationwide in the relentless pursuit of return on investment. Here's your host, Jason Hartman.
It's my pleasure to welcome a returning guest back to the show, and that is my friend Paul Moore, and he is going to tell us today about the opportunities in this very strange economy with mobile home parks, self-storage, and multifamily housing. Paul, welcome back. How you doing?
Hey, I'm great. Thanks for having me on again, Jason. This is a wonderful opportunity.
It's always good to talk to you. Paul, I got to tell you, I've been a little bit puzzled about one of those asset classes because, I kind of feel like it could go either way in this post-pandemic world, Well, I guess we're still in it, right? We might be in the pandemic forever. I'm not sure when they're releasing COVID-21 or COVID-22.
No, they flattened the curve a year ago this week, I think.
Did they really? Okay, good. There you go.
Did you hear?
There's a rabbit hole we could go down here, but let's refrain.
Okay.
At the risk of this video being canceled by cancel culture, it's self-storage. I'm really curious as to which way that one goes. For example, does demand increase or decrease as we see people moving from urban areas to more suburban areas where they have more space, right? They might move from a condo or an apartment where they didn't have a garage, and now they have a 2-car garage. They got lots of space, right? And a bigger house. So maybe lessening the need for self-storage, or I don't know. I'm just not sure. What do you think?
Yeah, I wrote a book called The Perfect Investment 5 years ago, and it's about multifamily. And I told my dear wife, I'm not going to jump around anymore. I'm going to stay focused the next several decades in apartments. Yeah. But Jason, I got to tell you, if I had to invest and the money couldn't be touched for 100 years, my money would be on apartments. I think the same apartments being built today will still be here in 100 years. And I think it's a great investment. All the demographics are there. But the problem is, I think right now it seems to be quite overpriced. Now, maybe we won't say that 10 years looking back, but from where I'm sitting, I feel like the perfect investment is no longer perfect, at least at the moment. And so we started looking at self-storage and mobile home parks. Self-storage does really well when the 4 Ds are happening. And the 4 Ds are unfortunate things, but they are death, dislocation, downsizing, and divorce. And we're seeing more of all of that in this pandemic culture. And so I don't think that means magically that all self-storage will do better. But when people are moving, when people are downsizing, when people are in turmoil, when companies are storing office furniture while they try to figure out what to do next.
Yeah, that's definitely a significant, and not just former office tenants, but also retail tenants. They've closed their stores. They've got all these fixtures and so forth. Yeah, no question.
Yeah. So right now, we don't know what it'll be like 5 years from now, but right now there's an increasing demand for self-storage. And some of that is in places where people are leaving, like Chicago, Manhattan, and LA. Some of it's where people are going and they're building new homes. I mean, we're selling lots and condos and houses here at Smith Mountain Lake in Virginia, a resort area. And there are people from Philadelphia, DC, New York escaping. And of course, also realizing they can pay lower taxes, have a better, funner life. They can do their bucket list now, and they can work from home. For the first time in history, that's not going to change. People know they can work from home for now. And so there's this massive shift. And while New York has bounced back after every tragedy and downturn and crime wave and 9/11, I don't know if it's going to bounce back the same this time. And I hate to go on record saying that, but I'm really concerned for the future of New York City. And, I don't want to see any place, even if it's a place I wouldn't want to live myself, I don't want to see it devastated. But it looks like, based on the numbers I'm seeing right now, it could happen.
Yeah, well, I definitely agree with you when it comes to New York. And I think, all the likely suspects, these high-priced cyclical market cities that are controlled by, just bad management, leftist administrations that chase the businesses away. They're not landlord-friendly. They're not business-friendly. They're very intrusive. They're taxing people to death. It's shocking. It's like they want to ruin themselves intentionally. It's a very strange scenario.
Very strange.
But I'm kind of curious. What did you mean by the bucket list comment that you threw in there? How will people be able to do their bucket list?
Jason, I've talked to a lot of people, and I'm actually one of them who's feeling like, America may not be the same in 5 or 10 years, maybe even 5 or 10 months, than it is now. Things are going really weird. Lots of stuff we never dreamed would happen in this free country are happening on a daily basis. And so I think a lot of people are saying, like my friend, an investor named Brian, he works for a large bank. He buys and sells and trades stocks and bonds. He shorts things. He's, doing some really smart stuff. And he's like, I've got like $1 million set aside to invest. And you know what this pandemic taught me? It taught me that maybe my best investment's back in my family. I'm going to buy a lake house. And he actually talked about that. Look, Jason, I had a bucket list myself that I've pulled into 2021. In fact, I bought a motorcycle the other day. Now,
be careful.
Well, I know it's a dirt bike, and I pointed out to my wife it doesn't have turn signals and it's not road ready.
Yeah, well, that's good. Stay off the road. I used to race enduro bikes when I was younger, and that was a lot of fun. And I just tell you, as long as you stay off the road, you have a much better chance, but you can still get pretty injured in the dirt.
No, I'm aware of that. And so I got this one, especially with these dirt-only tires. You can't even go on the road except you ruin the tires. And I got no turn signals, and I'm not getting even a license, I can't go on the road. But here's the point. I never planned to do that until I got a little older and could relax a little bit more. I'm getting a four-wheeler. My son bought a cabin way out in the Blue Ridge Mountains, and we're actually outfitting it to enjoy. We're doing more hunting, more fishing. My daughter and I are possibly going to do a Jeep trip across the Rock Rimmer Trail this year from Utah to Colorado. We're doing all kinds of things we hadn't planned to do.
You're doing America-centric things, not flying to Europe, doing things that you can, got it. A lot of people
look, if they say I can't travel without the right beliefs someday or without a stamped medical ID saying I've done all the right vaccinations and things, I want to be ready for that. And one way is I'm going to see the Grand Canyon this year. I'm not going to wait till 3 or 4 years from now.
Yeah. Good. Okay. So people are doing those bucket list items, those in-country bucket list items, and that's true around the world too, of course. Yeah. What else do you see? This trend of businesses storing their goods in self-storage facilities, certainly true. There's a need for that. But is that a permanent need?
Yeah, I don't know. I just don't know if it can predict it. And that's why I made the comment 10 minutes ago that if I was going to look 100 years down the road, my money would first be on multifamily, second mobile home parks, and third self-storage, because the need really changes. And I don't know. I know that for the next number of years, my money's definitely on self-storage.
Okay, good. So tell us more about why you like the self-storage asset.
So self-storage has 53,000 facilities in the U.S. That's about the same as McDonald's, Subway, and Starbucks combined. Yet about 50% of them are owned and managed by mom and pop operators. Now, contrast that with apartments. 93% of apartments above 50 units are controlled by companies that have multiple assets. They're professionals. They've already squeezed all the value add out of the apartments. But self-storage is quite different. It's easy to run a mediocre self-storage facility, but it's really hard to run a great one. And so by acquiring a mom and pop self-storage facility, you can pay them top dollar in their mind, and it actually is a great price for what they have. But you can take this asset and you can do all kinds of value adds to make it really perform well and have a higher value. Now, when I first heard about value add in self-storage, I laughed, Jason.
Yeah. What are you going to do? Decorate the place?
Yeah. What are you going to do? You've got 4 pieces of sheet metal, a floor, and a door.
Yeah.
So what are you going to do?
That's exactly
value?
what I was going to ask. But before you go into the value add, just a quick comment. I mean, the self-storage marketplace has been very corporatized by big companies. There are a lot of big players in that business. Yeah. It seems as though you're kind of saying the opposite, no?
No, I agree that there are a lot of corporatized areas. But I mean, look, you and I live in cities where there is a lot of, we live in and near cities, but there are also places, there are thousands of small towns around America where the demographic need for self-storage is just as relevant as it is in West Palm Beach or Fort Lauderdale Northern Virginia, Raleigh, North Carolina. There are small towns that you haven't even heard of, Rocky Mount, North Carolina, or Rocky Mount, Virginia, where there's a need for self-storage. And a lot of those are mom and pop run. But the value add still works just as well there. For example, you could add U-Haul. Let's do the math on let's just go through a couple other value adds and I'll do the math on U-Haul.
Now, is that U-Haul, when you add U-Haul, is that do you buy a franchise from U-Haul to do that?
No, actually, you just set up a commission agreement to store and manage their truck rentals out of the front door of your facility. Mm-hmm. And so there are other value adds as well. That's like adding a showroom with locks, boxes, tape, and scissors, charging insurance, charging an upfront fee, charging late fees, adding storage. Like a lot of these storage facilities might say, I'm selling the 250 units, but I've also got 5 or 10 acres in the back. We don't really use that. Well, that's a potentially great place for RV or boat storage, which can be quite profitable, or a chance to upgrade and add climate controlled self-storage. That's a real biggie. Let's just look at one of these value adds. Let's say I bought a $3 million self-storage facility. Let's say it's 300 or 400 units and there's no U-Haul. Let's say that's just too much hassle. Let's say as an operator, as a professional operator, I realize there's a need for U-Haul in that location. I sign a contract with U-Haul. Now, let's say I spent $3 million on that facility, $2 million debt, $1 million in equity. And let's say the commissions from U-Haul are between $2,000 and $5,000 a month. Let's assume $3,000 a month.
So what kind of scale facility, give us a reference point. Is that a 200 unit self-storage facility that would potentially generate that much in commissions from U-Haul or not?
The beauty of it is it doesn't matter. In fact, you could take a 100 unit self-storage facility that might be kind of a laughable acquisition that you wouldn't even want to do and use it as a jumping off point because now you have the land, the space, the location, the signage, the front desk, and you can use that to do any size U-Haul operation. Depends on the demographics of the area and the U-Haul competition in that area. So let's say you could make it go $3,000 a month. Well, $3,000 a month is $36,000 a year. My mama told me I was good in math. And the $36,000 a year, now, the value formula for multifamily, self-storage, mobile home parks. It's the commercial value formula, which is the net operating income divided by the cap rate. Well, that $3,000, that $36,000 a year divided by a cap rate of 6% is an increased value of $600,000. Now, Jason, what I just told you is that $1 million in equity is just now increased in value by 60% just from signing and implementing a U-Haul contract before doing all kinds of other value adds.
Sure. Okay, great. That sounds awesome. So the 2 questions there are, how long do you need to let that U-Haul income germinate before a buyer will consider that value add to be a real thing?
I would guess that if you looked at a normal market where there's not a frenzy like we have now, you might say a year. You want to say that germinate for a year to look at a whole 12 months of financials. I can tell you that we just were part of an acquisition in March of 2019 in a little town called Beeville, Texas, 607 units. And the acquisition was made from 5 kids who were all fighting and they were desperate to sell. The property was acquired for $2.4 million. It had no website, to my remembrance. It had poor management. It had no good marketing. It had like huge delinquency, very high delinquency, 80% occupancy, no U-Haul. And so basically the delinquency was eliminated. The occupancy was brought up from about 80 to about 90%. When I say delinquency eliminated, I mean it was taken down to a normal level of, let's say, 5%. The U-Haul was added. Showroom was added with, ancillary items. By the way, U-Hauls typically increase occupancy dramatically because people who need a U-Haul often need a place to store stuff as well. So that's a benefit. But we bought this for $2.4 million in cash in March of 2019. July 1st or so, it had an appraisal on it of not $2.4 million, but now $4.6 million. So debt was added to this all-cash facility of $2 million, which was 43% debt on this $4.6 million facility. And then about a year later, it was, continued to be stabilized, got a new appraisal for about the same amount, sold the property for $4.6 million. Now that $400,000 in equity that was remaining after that was financed in summer of 2019, that $400,000 turned into $2.6 million in cash out. And so it was something like a 400 or 500% IRR in 18 months on this self-storage facility. And that happened because we bought right from a mom and pop seller and we did the upgrades to make it a professionally run facility. Another thing that happened at that facility was the rates were 30% below market levels. And that is obviously a huge value add. If you can add 30% to your income without increasing your costs, you can almost double the value of the equity from that alone.
That's really incredible. So the question probably everybody's asking right now is, how do you find the deals? I mean, deal flow is key. We are in a market where capital is just trying to buy up every real estate deal out there in any category, whether it be, the single family market is insane because, we deal mostly in the single family, helping investors build nationwide portfolios, and virtually every piece of inventory sells, many with multiple offers. I know it's that way in other asset classes as well. How do you find deals?
Yeah, so I'm going to give away a little secret here. The best way to find deals, in my opinion, is to do what we often talk about but rarely implement well, and that is to get a team of people with a qualified list of phone numbers and get them calling. And so the most successful operator I know doing this has a team of 5 people sitting in a room with cubicles. They're calling 8 hours a day, 5 days a week. They're covering 100 to 150 mobile home park and self-storage owner operators a day each. And so they're able to cumulatively go through 500 or 700 a day, and that's a couple thousand or more a week. And this is basically covering the entire universe of national targets several times a year, maybe 3 times a year. They're able to go through tens of thousands of these. And so by doing that, they're there at the right place at the right time when somebody wants to sell. Like these, okay, so take these 5 kids in Beeville, Texas. They really wanted to sell. They had that place on the market for $5.2 million, and they accepted a $2.4 million offer. Another guy in Michigan, they called him quarterly for 7 years. He was 88 when they started. When he was 95, his niece called them and said, hey, we finally talked him into selling his 300 space mobile home park. We'll just accept whatever offer you made years ago. And he said, well, wait a minute, is that enough? This is what the buyer's saying this. And the seller said, yeah, that's more than enough. He'll never be able to spend that $7 or $8 million anyway. And so that's the kind of thing where you just have to be in the right place with the right seller at the right time.
Yeah, it's I had Harvey McKay on the show years ago, and I always love the title of one of his books, "Dig Your Well Before You're Thirsty." And
nice.
that's a prime example of that. Good stuff.
That's great.
Okay, so deal flow through telemarketing. Anything else on the deal flow?
Yeah, there's another way to do it. I know another company who's actually in your area, and they actually show up on the ground every week. This guy flies somewhere 50 weeks a year.
Oh,
and
that doesn't sound like fun.
He shows up and he drives around the region looking for all the smaller mid-sized facilities, going to the door, knocking on the door, and basically trying to get to the owner. And their goal is to actually put together a whole, bunch of bolt-on facilities among a central hub. Let's say he might fly to Memphis this week, and he'll look around a 2 or 3 hour radius around Memphis for every storage facility he can find to put together a deal with. So that's another way to do it. I know another guy who claims he does something similar using Google Maps and Google Earth. He says he actually finds facilities that aren't even on the map. And I can personally attest to the power of that one. I actually bought and sold a mobile home park in Alaska last year. If you actually go on Google, you won't even find this 200 plus space mobile home park. It just said such and such RV park. Didn't even say it was a mobile home park.
Mm-hmm. Yeah. So RV park, obviously different than mobile home parks. And so the misclassification of these assets will keep your competitors away, right?
It kept competitors away, and it also kept the occupancy lower than it needed to be because it was a very transient town.
Oh, good
point. When people are moving in and out of that area and they were looking for a mobile home park, they weren't actually necessarily coming up with this place.
So now we're definitely transitioning into the mobile home park discussion. Anything you want to share there? I know we've got to wrap it up soon, but we talked mostly about self-storage. We're not going to have time to touch on multifamily too much today, but mobile home parks. I love it. I own one myself. It's been a great investment. You can apply a lot of value-add creativity in those. I know that from firsthand experience.
Yeah, Jason, it's the only asset type that I know of that has an increasing demand and a decreasing supply every year. It's believed that there are about 45,000 mobile home parks nationwide, and it's believed that 85 to 90% of them are run by true mom and pop owners. A lot of them have had them for decades. A lot of them might be, living somewhere else or even living on site. Their rates are far below market. Many of them still pay the water and sewer bill and
they could submeter those.
And so the value adds there are raising rates to market level, submetering out the utilities, bringing in more homes. That's a biggie because mom and pops sellers in any asset type typically don't have the knowledge or the desire or the resources to upgrade and make these value adds. Now, think about this. We bought a mobile home park. We were part of an acquisition last February for $7.1 million in Louisville, Kentucky. The seller had passed away 5 years before, and his spouse had never been to the park, at least in those 5 years. She was 3 states away. There were 50 vacant lots out of about 311 lots at the facility. And she wasn't going to spend the $40,000 or $50,000 per mobile home to bring in mobile homes to fill those spots. So that was one potential value add. A second potential value add was the rates were 25 to 35% below market. And the big one, the third one, was utilities were being eaten by the owner. And so acquisition for
meaning the owner was paying for them.
The owner was paying the water and
he wasn't eating the utilities. Okay.
Well, exactly. But anyway, so it was acquired for $7.1 million. That was about $3.5 million in equity, about the same in debt. A week later, it got an offer for $9.5 million. They turned down cold, even though it sounded like a good deal. And he said to me, nope. This was the operator talking. He said, I can get this thing to 12 or 13 million within 3 years. You watch. So he passed the utilities back to the tenants. That increased the value $2 or $3 million right there. He raised rates some, but not, of course, he didn't raise them 25 to 35%. but he raised rates some, and then he started on a program to fill those vacant lots. Well, 6 months into ownership, he got an offer. It wasn't for 12 or 13 million, which was his target. It was for $15 million. And he sold the park in December with a 340% plus IRR and a huge windfall to investors. And so we love mobile home park self-storage deals like that have a lot of value add. And that was certainly one of them.
Good stuff. Good stuff. Paul, give out your website and wrap it up with any closing thoughts.
Yeah, our website is wellingscapital.com. That's WELLINGS capital.com. If people would like to get an ebook on self-storage or mobile home park investing, or even a general course on commercial real estate investing intro, you can do that at wellingscapital.com/resources. Closing comment, I would just tell people the same thing that I've been trying to live by for years, and that is I made a lot of mistakes early on in not understanding the difference between investing and speculating. Investing is when your principal is generally safe and you've got a chance to make a return. Speculating is when your principal is not at all safe and you've got a chance to make a return. I will say that investing beats out speculating on average every time.
Yeah, I would wholeheartedly agree with you. Paul, I got to ask you a question about that, and not to go too long here, but I've always said that the definition of an investment is that it produces income. Mm-hmm. If it doesn't produce income, it cannot be called an investment. It can only be called a speculation or a gamble, which, by the way, I want to make the disclaimer about that. You do sometimes make money speculating and gambling. And I do it a little bit myself, okay, even though I'm pretty conservative and I like income investments. Would you agree with my definition?
I totally agree. I love that you said that because I wrote an article that said, what is true wealth? True wealth is having assets that produce income. And those are true investments. Now, at the same time, it's not wrong to speculate with a small percentage of my money.
I agree.
Like if I want to buy gold, silver, or Bitcoin as an insurance policy, fine, but I'm not going to depend on that for my livelihood. And if that money goes to zero, it's not going to crush me.
Right, absolutely. And the rule, I believe, on speculations is it must have an asymmetric risk-reward ratio. If it doesn't have that, you probably shouldn't be speculating because you've got to get a very high upside to offset that risk. And I don't think that gold has that. Silver could, I guess. There's a million experts out there. I'm not one of them. Bitcoin certainly could, but it could also, it could go to zero. Right. We all know that. So very,
That's right. very risky. I love what you said, and I'm going to add that to my arsenal because I never thought of that asymmetric thing. People think low risk leads to low return, and that's true.
Right.
High risk, therefore, leads to high return, but that's not true.
Yeah.
It leads to the high risk leads to potentially high return or potentially total loss.
Yeah. Good stuff. Well, Paul, it's always great to talk with you. And thanks so much for joining us today and sharing your wisdom and your insights.
Thanks, Jason. It was great to be here.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.